This is the Insight is Capital podcast.
The views and opinions expressed in this podcast are those of the individual podcasters and do not necessarily reflect the official policy or position of advisoranalyst.com. This podcast is meant to be for informational purposes only. Nothing discussed in this podcast is intended to be considered as advice.
Hello and welcome to the Insight is Capital podcast. My name is Pierre Daly, managing editor of advisoranalyst.com. Our guest is Hubert Marleau, founder and market economist at Palos Management Incorporated. In the past, he held the position of chairman and chief executive officer of Marleau Lemire Securities. He was a governor of the Toronto Stock Exchange, the Montreal Exchange, and the Vancouver Stock Exchange, as well as having been senior vice president at Nesbitt Thompson and Nesbitt Burns, and senior executive vice president at Lévesque Beaubien Geoffrion and at Lévesque Beaubien Incorporated. Without further ado, our guest, Hubert, welcome to the show.
Thank you. Happy to be here.
Wonderful to have you. So, first of all, Hubert, what is your firm? What are you guys hearing from your clients?
I think the clients, basically know that this whole business about the coronavirus was an exceptional accident that, of course, had led to some extraordinary measures. And they're basically waiting to see how this all ends. There are evidently always some investors that are more nervous than others.
Right.
And consequently are probably asked more questions or more concerned. But generally speaking, our investors are relatively calm and just are awaiting for better times in the hope, that this pandemic ends, because they do believe, that at the end of the day, there will be a return to some normalcy. It may not be the same as we had before, but close enough that we can all basically live our investment lives and apply investment strategies, that were normally work under normal circumstances.
I'm all but certain that it's making for a lot of very interesting conversations.
Well, yeah, the conversation actually, more often than not, is really not about which stock to buy or which stock to sell, because they're pretty self-evident as to what you should have owned throughout. You should basically be invested, with what normally is called defensive, also in what is likely to reap the benefits, of being quarantined into your home, and at the same time be invested in things, that are not that affected, or at least not tremendously by the pandemic and by the lockdown and the shutdown of businesses. For example, we've invested in what everybody else has invested in: high tech and food, and these things weigh more heavily than they normally do. But now we're starting to change a little bit our strategy, where we're basically looking for situations, that are extremely undervalued and nibbling at those particular positions in the hope, that we can get some alpha out of it. So we've invested in gold, and we basically decreased our energy exposure very significantly. But we kept certain things where we think there is long-term hope that may not necessarily do all that well. So we like copper and we like lithium.
Yeah.
And we like Shopify, to sake of an example. And we own it, so thank God. Good thing we own it, because it basically kept us in the running, let's put it this way. These are all fine and dandy, but they're not necessarily the big, broad things that we should be concerned ourselves with. I think that there will be a number of changes, that are macro and not necessarily micro, like the ones I just mentioned, right, which are likely to basically change the way in which we will be investing in the future. So, I think if we're good enough, stock picking might be a better way to invest in the future. I also think that there are some situations out there which are extremely have deep values. That mean that they're so depressed. That they really can't get any more depressed than they actually are. And we find this basically in non-essential goods, like recreational goods and things of that nature, which could lead to very interesting returns. But beyond that, there are, in my judgment, probably 5 or 6 big big macro themes that are likely to evolve out of this, one of which I believe we're going to have much more what I call state capitalism and little bit and less liberal capitalism. What I mean by this is that there's going to be significantly more government interference, in the matter in which business is actually conducted. I mean, normally businesses tries to balance, short-term with long-term profit objectives. Now they're going to have to take into consideration what are the wishes of government and what are the long-term objective of government. I suspect this will enter the equation quite dramatically. It also basically means, that big companies are likely to stay big and become bigger. I particularly like companies that are in situations that are in duopolies, oligopolies, monopolies, or also companies that are in monopsonies.
Yeah.
By monopsonies, I basically mean, a company that has access, to have many clients, but they're the only one around, or they are the only one around that's basically hiring the people in a particular area or in a particular country. Amazon is like a little bit of an example of a monopsony, and also a monopoly, almost any kind of an oligopoly also at the same time.
Right.
But these companies, are going to be are going to grow bigger at the expense of the smaller ones. But it's going to fall in that state capitalism thing. And that's probably a main reason why the big companies are actually faring better than the small ones. And, and some of the small ones are probably going to stay small. So that's one big theme. Of course, and the other one, which basically will be a derivative of this state capitalism, is that we're going to have deglobalization, protectionism, probably more populism also.
Right.
The populism could be as much left as it could be right. It doesn't really matter. Populism is populism in the end. So that you'll give you more of that, and that will fit in with the state capitalism that I'm really talking about. I don't want to give the impression, that we're going to Nazism or whatever like this, but all I'm trying to say is that the characteristic of liberal capitalism will be amended, and the amending of this will be more like state capitalism. I also think that down the road, not now, because it'd be an almost an impossibility at this point, because there is an abundance of goods around. There will be down the road somewhere the possibility, of having an inflation rate which will probably go above the target rate. Now, when will this happen? We're probably 3 years away from that. It takes a long time for monetary stimulus, to translate itself into inflation. It can take an awful long time. But that, to me, is a possibility, and it will be, and it will change things around to some extent, where basically inflationary sensitive investment have not done very well lately, but in the future they might be doing a hell of a lot better. And I think this will come. We're going to start to see some of this probably in 2021.
Right.
There are many other broad things. Evidently, state capital will bring more scrutiny in the matter in which management actually runs their businesses. I think it's going to lead to a little, whether we're going to be right or left, in this populism, it's going to lead to things like possibly we could have wealth tax, where we could possibly get a higher basic universal income.
Right. And what exactly are the things that you think will give rise? Is it, for example, is it a matter of, government then turns around post this period and says, look, we have borne the brunt of the cost for this economic recovery out of the pandemic, and now it's your turn. And now we believe that it's corporate America's turn or corporate world's turn to repay this debt.
I don't think it's going to be basically like that. I don't think that my judgment, corporate taxes are going to go down as opposed to go up.
Wow.
It's more like wealth. In other words, you're not going, what's the point of taxing, let's say, any company? Like, let's use, why tax IBM? It'd be much better, to tax the guy who owns IBM.
Yeah, okay, sure.
In other words, you're more likely to make sure that industry remains extremely efficient and as productive as possible, that at the same time they use the bulk, of their cash flow to invest in capital expenditure and so on and so forth. But those who basically benefit by being owners of these businesses, assets or of real estate or whatever it is, whatever wealth happens to be, that's what's going to be taxed. I think it's much more likely to take that kind of form.
Right.
And that wealth tax, will translate in part financing, all the things we've done lately, all the stimulus that we basically, which at the end of the day, someone has to pay. You're either going to pay in taxes or you're going to pay in inflation. Probably going to be a combination of both. But at the same time, you may end up in saying, you know what? Basic income, let's have a basic income across the country, which basically says if anything ever happens badly or whatever, people will always have enough money, not to buy luxury, but they're going to have enough money to go to Loblaws and Metro to buy what they need.
Right.
And be able to pay their rent. So that's going.
It's ironic that when Bernie Sanders was talking about how he was going to finance his political ideas, which included universal health care and universal education for everyone, that he was going to do that with some kind of a transactional wealth tax. And this idea from Bernie Sanders could be one that actually takes hold politically, is one thing. And then the other thing is the universal income idea, which was put forward publicly by Andrew Yang. These are interesting ideas. What was interesting was that maybe a month after, or a month or two after the Democratic primaries began, these ideas began to take hold. This is a very exciting conversation in terms of getting sort of a view of how things might change down the road.
Well, it's going to be evidently, it's in the beginning. If you would have asked me this question before the pandemic, I would say, we're going towards that route, but it's going to probably be a 10-year thing. Now, I think we're going to be going on that route, and it's not going to be a 10-year thing. It's going to be probably cut in half, probably going to be a 5-year thing. Because, politicians are not stupid. They will hit the higher end when it's hot.
Yeah.
And right now, if you had a basic income, for sake of example, across the country, you wouldn't have necessarily have needed all of these various programs, which get very red tape, very tedious, very hard to understand. A lot of people basically can probably make claims, but they don't know how to go about it, so on and so forth. But if you're a citizen, you will get a minimum amount of money. And so that at the end of the day, no matter what happens, you're going to be able to survive.
Right. I mean, it goes to the discussion that's been going on for many years, which was like, for example, in Canada, and correct me if I'm wrong, but 46% of Canadians have $200 in their bank accounts, which means basically they're one paycheck away from a disaster in terms of being broke. What this pandemic has done is it has revealed that vulnerability in the starkest kind of way that you can do that.
Well, when you really think of it, there's essentially 3-4 things that, in my judgment, are important. One is what I would call survival, which really has to do with shelter and food. And then I think health, should be. I'm a conservative. I don't sound like one right now, but I do believe, that healthcare should be for everybody and just not for those who basically can afford it. Right. And I do also believe, that education should not be just for those who are lucky.
Right.
It should be as broad as possible. Which it is pretty broad today, but I'd like to make sure that it stays that way, because the only way that a society can progress is whether or not it is knowledgeable or not. And the more knowledgeable it is, the more likely that it's going to be productive. And the more productive it's going to be, the more efficient it's going to be. And the more efficient it's going to be, the more profitable it's going to be. And it brings all kinds of societal benefit if an economy is profitable. That is why I'm against corporate taxes. I think it's a very silly tax.
Right.
It's a stupid tax. It hardly collects anything anyway. As a percentage of the total revenue of a government, it's nothing. But it incentivizes people, to save and invest as opposed to save and hoard, because the return, But if I'm going to make millions and millions of dollars, I don't mind personally to say, well, some of that wealth should be maybe taxed to a certain degree so that it will be able to pay for the basic income of everybody. I mean, you explain to me why a corporate executive can make 20,000 times more money, than the guy who is basically working in the cellar. I mean, it's ridiculous. Right. I've been there and I've seen it. I've been president of companies and so on. So I've been on board of large companies. They're not only smarter than you and I are. They're just the same. They're humans. They're people. They're just normal people. And they just happen to maybe worked harder, or maybe they were lucky,
Right.
or maybe they specialize in something and which turned out to be quite good, or whatever. But there's all kinds of reasons for it. They're probably also smarter. But smarter or more intelligent is a gift of God. So in my view is society, in my judgment, is just a little bit too unequal. But the best way to bring it equal is by making it as efficient as possible.
Right.
And the best way to making it efficient is not taxing people or things, that are productive. I mean, it's much better if I'm very rich and I take my savings and because I want to buy myself, a cottage, on the St. Lawrence River so that I can actually look at Whiteface Mountain. Is one thing. Or should I take that bloody money and basically buy or invest, in a business, that's going to be producing something which the nation as a whole can use. One is wasteful savings, and the other one is productive savings.
Right.
So if there's no tax on corporation, I'm much more likely to move that money into investing, acknowledging, that my return will not be taxed. Now, and if my value of this goes up from 1,000 to 10,000 to 20,000 to 50,000 to 500,000 to $1 million to 10 million to 50 million, maybe at 10 million and up, I don't know, some number, I don't know where that number is, but maybe you should pay 1% management fee.
Right.
Or 0.5%. What the difference does it make if I'm worth $1 billion and I have to give away $10 million a year out of my wealth?
Yeah.
It's nothing. People say, well, I give it to charity. Yeah, but charity is not necessarily for the benefit of all people. It's only for the benefit of that charity.
Exactly. Yeah, you make an interesting point. I think I have a feeling, to be conservative in Canada and to be conservative in the US is two different things.
That's for sure.
I think we have a much better balance on life in Canada than Americans do. I was just going to add just that, it's not hard to see why populism has grown the way it has in the last decade. Of course, I think the global financial crisis gave rise to it because of what you mentioned just a few moments ago, which was about the zombie companies being bailed out that should have, many companies should have been left to fail. I think that's been what gave rise to populism. It's the inequality, of course, that's given rise to populism. It's the free run that appears to have happened. Nobody's ever taken actually any responsibility. And that I think is really what's pissed off a lot of people, especially, and if you consider 46% in Canada, which for the great country that we are in terms of our social system, it's surprising that we haven't seen more of that populism north of the border. Yeah,
you're seeing it to some degree, but it's certainly not as prevalent. When you're living in big cities like Toronto or Montreal or Vancouver, evidently you don't see it as much. But where I have my country home,
right,
which is evidently much more rural, you see it a hell of a lot more. The idea of populism is much larger and thriving, for that matter. Another big theme too, which I mentioned state, but like I don't want to miss out on this one either. I think that there's going to be, and I've been saying this in many of my weekly letters, that there will be a significant increase in what I call personal and corporate savings. I think this is going to happen because people might have realized the fragility of our system, of our economy. And at the end of the day, I believe that people are going to start to save a lot more of their money than they have in the past. The personal saving rate, particularly in Canada, is atrociously low, and it has to go up. And I don't know where it should go, but it would be kind of nice if we could have an 8% personal saving rate. It would improve our balance sheet. It would make the balance sheet of households far more healthier and all that sort of stuff. And I see the same thing with corporation. I think that the eras, of buybacks and large percentage, of your cash flow being paid in dividends, in my belief, is going to be much more a function of profit than actually what a payout is. In other words, a company like, I'm not saying BC is going to do this, but I'm going to use BC as an example. Why would not BC say, you know what, I will pay 30% of my profit in dividends,
right? As
opposed to say, I'm going to be paying, $1.52 a share. I think there'll be a lot of that sort of stuff that's going to go on, in my judgment, that will bring a conscientiousness towards higher savings. So That'll have a significant repercussion on many things. It's going to change the consumption function, the composition, the consumption, the evidently of consumer expenditure is going to change.
Right.
It's also going to change, the manner in which corporations actually spend on their monies, on capital investment. You've already seen trends where a corporation is spending more and more money on R&D, on software, on application of where they use artificial intelligence and that sort of. You're going to see a lot more of that and far less physical type of capital expenditure. It's physical still represent the largest part, but that's going to, in my judgment, this is going to decrease quite significantly. And this is particularly true if we are right, in the belief that there's going to be deglobalization. If deglobalization comes in, and of course that's going to end up in a disruption of supply chain. Now, given that it costs a hell of a lot more money to hire labor, say in North America, than it does in China or India or whatever, there will be a significant amount of money are going to go into software. And of course, the industry that's going to benefit from this are going to be the high-tech software type businesses. And of course, and Canada's lucky. We have a lot of good software companies, OpenText and a bunch of others. I mean, they're all, in many ways, Shopify is a little bit like that.
Right.
It's the application, of artificial intelligence. And this is going to be, to me, a big deal. Evidently, there's going to be a lot of money they're going to pour into health services. But that's almost evident. It's too evident to even talk about it. It's like saying, when I'm going to get up in the morning, I'll be breathing. Of course I will.
Look at a company like Tesla, for example. This is not a company that is building cars with thousands and thousands of assembly line work. These vehicles are being built by robotic assembly, and really it's the robots just need supervision. It's no wonder that companies like Tesla are fetching so much confidence and so much valuation premium compared to what it's actually producing. And I think that goes to, you mentioned OpenText and you mentioned Shopify. Online is getting a premium. And it's just surprising even to see companies like Zoom, which is questionable now, but fetching a market capitalization of $40 billion, which is in excess of most of the large automotive companies' market capitalizations.
Yeah. This also brings me to another thing. This evidently, I will consider Zoom as part of the software area where efficiencies can be used and so on and so forth. I mean, my family office, we own several businesses, and we're now realizing, that a lot of the things that we always thought had to be physically there all the time could actually be done elsewhere. So we use a lot of Cisco's WebEx, which is very good, by the way. There's another thing too which I mentioned that state capitalism is going to bring, to the extent that it's going to bring protection and so on and so forth. And this is going to be strategic material. I don't think that in the future we're going to allow, as easily as we have in the past, to have strategic material not in close range. And by strategic material, I mean things like copper, moly, scandium, niobium. Not all the materials are considered strategic, but these there are many others by the way, than the ones I just mentioned. But there will be a movement, to keep these things closer to home in the eventuality that there could be some problem, because there's a very strong possibility we could end up maybe not in a pure military conflict, but in some kind of a war that may not be military, but a war that will be trade barriers and so on and so forth. So you'll want these things to be close to home much more than it have in the past. And also the state capitalism is going to create another thing too. It's the ownership of businesses. There's going to be a lot of emphasis that businesses that are, say, in Canada or the United States or England or whatever, and that they're not be as easily sold to foreigners as it has been in the past. In other words, I would have a hard time believing that company like Magna, for sake of example, could easily be sold to a foreigner. It's not to say that that our major Canadian companies, okay, would not invest abroad. That's not what I'm. Yeah, sure, they will continue to do it to the extent that it makes sense and it's profitable and the rest of it. But what I'm really trying to say is that there'll be, I think, ownership of what is American or what is Canadian is going to become important. It's not going to be that easy for a foreigner to come and buy, okay, our jewels.
Right.
Like Canada is a very good example. We give away our
we have given away the best of everything we've ever created.
Yeah, we gave away nickel. We gave away everything.
That's not just it. I think, you know what surprised me the most, Canada has been the home of some very significant inventions. Yeah. The charged couple device that goes into, you know, every camera, technologies that gave birth to mobile telecom. All of these inventions were born in Canada and sold away because, you know, we couldn't raise the capital.
But there's an easy solution to this, Pierre. And the easy solution is that if we need to create incentives in Canada, more, and we have some now, evidently, but much more, to get this personal savings up and to get corporate taxation down and other taxation, okay, that are related, okay, to that basically hurts private savings, whether it be corporate or personal, so that we can have the monies, the capital, to be able to keep our businesses in Canada and also to create new ones. The main reason that we have a dependency on foreign capital, okay, which of course comes from the fact, okay, that we always have a balance of trade that's deficit, but most of the time, not all the time, but most of the time. And so we basically get this foreign capital in, and that foreign capital does not only want to buy Government of Canada bonds, municipal bonds, okay, issued, okay, by the city of Vancouver or by the city of Toronto or the city of Montreal. That foreign capital would be we would not depend on this, okay, if our personal saving was higher and our corporate taxes were lower, because we could provide the capital necessary to keep our stuff here. We have to sell because at the end of the day, we can't make the balance of the economy. The economy cannot balance itself if we don't. Of course, a lot of it is also the fact that, you know, we have too much entitlement and you know, our welfare system is way, way too expensive. Way too expensive. We all, you know, but
parallel to what we were just talking about with regards to, you know, Canada or Canadian companies selling away all the jewels to foreign interests. We've kind of seen the beginning of what you're talking about, which is this deglobalization, or the growth of the idea of deglobalization. Sort of has become evident in situations like the Huawei situation, right? With the CEO, the daughter of the CEO of Huawei being arrested in Vancouver, you know, at the behest of the U.S. government. And then the whole controversy of, you know, Huawei being charged with trading with enemy countries like Iran. And then the blockade of Huawei from accessing technologies that are now owned by, for example, SoftBank, which owns ARM Holdings, which is the chip designer for almost everything in the world. And when you see that kind of blockade, that's really the beginnings, and that's forcing Huawei to resort to its own chip designs, and that's really the first. I mean, ARM is a British company, but SoftBank was able to completely buy out the company, which is British, out from under Western interests. So when you see that kind of thing happen, and something so strategic as ARM, as 5G, you know, there's been a big push too from companies like T-Mobile to promote the fact that they have already established a 5G network. Those kinds of examples of technologies that will really, you know, be a big part of our future and our future development and productivity. Couple that with also now, you know, strategic metals, for example, which are used in technology, which are used in defense technology. I've often wondered, why are we so good at trading away our best assets? What's surprising is what it has taken in order to begin to expose these vulnerabilities that existed. The pandemic has really exposed the vulnerability of the labor class. And so when you see, you know, like that, you know, in a week of legislation, a week of, you know, the law coming down in terms of shutting down the economy, the millions of people, the tens of millions of people who have being suddenly put out of work and being shown really how vulnerable they are, I can see where that gives rise to the savings rate. Like and ultimately invest. It makes a lot of sense. The outlook that you've shared so far, it makes a lot of sense to imagine that the savings rate in this country will go up. And then along with that savings rate, the confidence in the savings, and then thus the confidence in investing across the board. But, that doesn't mean everybody's going to suddenly become investors, but people will feel less vulnerable.
But it doesn't matter, because if I'm saving and not investing, for example, but it will go into the saving is going to go in the bank, and the bank now has a deposit. The deposit, it creates a reserve at the central bank, and you can then use that reserve to make a loan. So, so at the end of the day, it all, whether you're the one that does it directly, or you're the person who allowed it indirectly, it doesn't make much difference as long as it's happening. At the end of the day, there are, in my view, it boils down to essentially, in my judgment anyway, the four big things. Technology, which means the robotics and all that kind of stuff. Software, which essentially means artificial intelligence, all that kind of stuff that falls under that category. And then strategic material, and of course the application of internet, which I will call it. They call it the Internet of Things, or the Internet.
And that's where 5G comes in.
That's where 5G comes in, exactly. So you basically, these are to me the big themes that is going to be derived from state capitalism, higher savings rate, and deglobalization. It's going to lead into that, because the big themes, or the big macro stuff is going to feed all those micro stuff, and then they'll go to the mini micro, which is going to be the selection of companies in each one of those high categories. Sometimes it's good to, there's a saying, that each time that has been a plague or a pandemic or some sort epidemic, that the world soon after turns much better. I mean, I don't remember where I've read this. I did read this in some of the editorial pages of some of the, top newspapers. I never wrote about this because I didn't think anybody would be really interested. But the fact is that there is some evidence of that, because the coronavirus situation is making us think twice about many things.
Certainly, right at the core. I mean, our core values.
Right. Because at the end of the day, we're just humans reacting to. I like to always talk about. I'm sure a lot of people read this book. It says there is a philosopher by the name of Noah Yardi, and he's as smart as you can get. Probably the best, well, in my judgment, the number one philosopher out there today. And he's also an historian. He also has a deep knowledge, of high tech. And he basically says, in this world, there is no laws in this universe. There's no law. There's no God. There is no nothing. But one thing it has is imagination, and with that imagination, man can basically solve just about anything and create just about anything, as long as it has the means to do it. And the means actually comes from savings and education. Right.
It's very simple. It's a very simple. It's a very simple philosophy.
The more simple, the more reliable it is.
It reminds me of Warren Buffett's that, it's when the tide goes out that you see who's not wearing any pants.
That's right.
If anything, this pandemic has revealed a lot of the places where there have been significant vulnerabilities. It has highlighted so much, and it has brought so much to bear for everybody to contemplate while we're isolated.
Yeah. Well, I belong to a club which is called the Phoenix Club. I happen to be the chairman of this club. We're about, I think we're 25 members. Most of the members are essentially successful businessmen and former money managers of the major funds in Canada. And of course, we meet every week. Right now, we're meeting through the use of Cisco's WebEx. And it's kind of interesting, because while you would think that people who are basically want to talk about specific investments, at the end of the day, the conversation always ends up on the big stuff. And the reason is because they're trying to find maybe solace in the hope, okay, that the big stuff can get resolved so that we can get to the small stuff, because it's with the small stuff that we make money.
Right.
So
that's interesting.
And then there were 25 guys, okay, and a lot of them and they're all these guys are all well known. I mean, they've been around for a long time. It's interesting to see how the group wants to talk almost all about the same thing.
What are some of the big things that you're talking about?
Well, they're definitely interested in the small stuff too. I mean, they all, at the end of the day, they will ask, should I buy Boardwalk, or should I buy Crombie, or should I sell BCE or whatever? At the end of the day, it's an investment club, but it's an investment club which is much more of a social club than an investment club. But we do have a portfolio, and, we invest. But the idea, they ask broad questions like, supply chain, national security, relationship between China, U.S., and, that sort of stuff.
Right.
Because if there's going to be a disruption of major proportions, say, between the United States and China, what is that going to do? It's going to create a lot of stuff. I mean, how does Apple fit in there?
Yeah, exactly.
And how some of the suppliers, okay, who are completely dependent on goods that come from China, or parts that comes from China. How is that going to work? And how will disruption or a catastrophe between these two nations, what is it going to mean to international trade? Are we going back, okay, to what we had before, two blocks? One block run by China, one block run by the United States, and how will would these two blocks be the same as it was in the past? It was easy to deal with Russia because they were poor, but the Chinese economy is not a poor economy anymore. It's a rich one, and has resources and capabilities and so on and so forth. You're not fighting something as easy as Russia was. The only reason why we never really fought Russia is because they had nuclear weapons. If they wouldn't have had nuclear weapons, it would have been the Cold War would have ended much faster.
The China question is certainly a big question to contemplate, I think.
Well, maybe, but then maybe not.
Yeah, exactly.
It's easy to say that, okay, but not as simple as it may appear. Who knows where the Middle East is going to end up being friendly with? I mean, the Middle East sells their oil, okay, to China and to India and to Japan. Who says, okay, that Western Europe or Eastern Europe is going to remain friendly, okay, with the United States? Maybe Russia will create a gas pipeline in which the Europeans are going to be dependent on. The geopolitical is going to be extremely complex.
That already happened, didn't it? I mean, that already happened with Gazprom, right?
Exactly. And this is not a simple thing. In fact, it's quite complicated.
I think there's probably also going to be quite a fair bit of public unrest about,
The only thing that at the end of the day is going to keep people somewhat sane is the fact, okay, that the stock market has not reacted maybe the way that a lot of people thought it would react. But, to me, most people misread this. They basically look at this pandemic as being caused, okay, by man, like the Depression was caused by man, or the great financial crisis was caused by men, and many other recessions were caused, okay, by bad policy, mistakes, and whatever your case might be. This comes out of left field, and I've seen a lot of people who have been extremely pessimistic and have made some very stupid mistakes. It's as if, you're saying, well, 2020 is a write-off, okay? It's a lost year. 2021 is going to bring back, okay, us to 2019, and then from 2022, okay, it's going to be the Brave New World. And the Brave New World is about all these big macro things that we're talking about, because in 2020, we're going to be awfully too busy to restore the economy to its natural health, okay, than to worry about the big macro stuff. The big macro stuff is going to come in 2022. No matter who president of the United States comes November, whether it's Trump or Biden, it will be about restoring the health of the economy back to where it was in 2019.
Right.
And these broad things we're talking about, while important, they're not going to be the big themes. They'll be the big themes in 2022. Because then, this is all big. So the stock market is not that stupid. It's like saying that you went into a coma. I'm going to wake up. And when I wake up, okay, in 2021, I'm going to be able to see the light. And don't forget one thing. The way I view it, what you're going to be getting it's going to be a square root, a fast, down. Like, remember the square root, the sign, so down.
The sign.
It's going to go up. I don't know.
Yeah.
It's going to maybe take a little U up, or maybe it'll be fast. It doesn't really matter. But there will be but it will not. If you remember a square root, it does not go up as much in degree as the first part of the shape. And then you're going to have a curve. You're going to have a straight line that's going to have a very low tangent, a tangent that probably will reflect, a couple of percentage in growth, and that's it. And why? Because the economy is going to be working at maybe 80% capacity. But it also means that if you're working 80% capacity, there's no recession in sight, because that means there's no recession. That means the economy will probably be able to grow, albeit at a slow pace, but at 2% for the next 10 years to eat up that extra capacity that is not being used. So the stock market is not that stupid. A lot of people have a hard time catching this, but I think what the stock market is catching that. Then you're going to have another guy who's going to come out and say, well, the bond market doesn't really think this way. Well, no, that's not true, because the bond market, is a function of the gross national product and the term premium and the rate of inflation.
Right.
So you got to put those three factors in. Now, quite evidently, the monetary stimulus that is being applied by the various central banks has basically destroyed the term premium. There's no term premium in bonds today. So let's assume that term premium is usually, I don't know, it's probably around $1.20. And let's assume, that the economy that I'm talking about is going to grow, say, at 2%. That's good for usually the economy is 60% of that. And I'd say the inflation, because there's such big abundance, may only grow at 1. You take 60% of that, that's 40. So all of a sudden, you're down to you're around 180. That's where it should be. But then that premium is gone. So you're at 60 basis point in yield. And that's exactly where we are.
Right. So you think that the bond market is telegraphing this already, what you're talking about?
People think they're telegraphing a recession. They're not, because you got to put that term premium back in. We just basically camouflaged it. We basically put the term premium in a bond.
Yeah, the old basis for these calculations.
That's right.
It's adjusted, and what we're left with is the adjusted look.
But in 3-4 years from now, it's going to start to change, because then you're going to be in 2023, 2020. Then all this monetary stimulus, all this abundance of supply, whether it be oil or like we've had, so on and so forth, is going to be sapped. Okay, and then, but that stimulus, that all that money, which is all that monetary base that we have out there, is still going to be out there. It's not going to disappear overnight. That's going to start to have an impact. It happened before. I mean, the main reason why the 60s turned out to be inflationary is really because of the monetary impact that you've had and the fiscal deficit that you had towards the end of the war, and which lasted up until about 1949, so on and so forth. But it took 5-6 years to turn to same. Nothing. It just doesn't disappear.
It doesn't disappear. It just takes time to.
That's right.
To surface.
That's right.
Yeah, but it's out there. It's like a giant submarine.
All of a sudden, crude oil is going up like crazy today.
Wow. That's something, like
it's going up 40. I think crude oil went up. I'm not too sure if that's right here, but I think it went up 40%. It's insane.
That's insane. Just when you look at the dislocations that have happened in the market.
That it's not normal. We're not. Nothing is normal right now.
And that's what I want to ask you now. With like, when you look at the behavior of the equity markets, what's happening is reasonable, or is there just a lot of technical stuff going on?
Well, there's a lot of technical stuff going on, and the algorithms are actually creating it. It's kind of funny that if the stock market is down a lot, you ever notice that the futures at the end of the day are up? And if the stock market is up a lot, the futures are down in the aftermarket, and so on and so forth. It's as if, it gets adjusted. My view is that based on what I said earlier, 2020 is a write-off. 2021 is going to bring it back to what it was in 2019. I think the stock market is stuck in a trading range, and that trading range, in my view, is like something like 2,500 to 3,000, something like that, something of that nature. It's in there. I mean, I'm not going to argue maybe it's 2,550 and maybe it's 3,050. Okay, but it's something like that. And it's going to trade in there. But inside of that, there's going to be a lot of opportunities. There's going to be
Sure. There's going to be a lot of volatility, isn't there?
Is one thing. That's what the algorithms are basically, working with. But inside the market, there will be people will be able to recalibrate their portfolio. There's going to be ideas of relative strength. There's going to be movements, from what seems to be expensive to less expensive. There are inside of that range, literally hundreds upon hundreds of trading opportunities, opportunistic trade, pair trades, you name it. That could make it very profitable for someone who is willing to spend the time to do it, which is really the job, of portfolio managers to do that. But and I'm sure many are doing that. We're doing it, and if we're doing it, I'm sure many others are doing it too, and probably they might be doing it as good or better than we do. I don't know, but it doesn't really matter. The point is that that's what's happening. And when you look at it, I use models. All my predictions that I make, or predictions of my views on things, I should say. My predictions are, I could be as right as they could be wrong, but they're based essentially all on mathematics. I don't use, like for example, I will use equity risk premium versus volatility. I do all kinds of neat little tricks, and those and I look at this historically, and when I do this, I find that this is the range.
Right.
So, and it kind of makes sense, because I said, well, if that's the range, why is the market thinking that way? Well, when you think of it, it's thinking that way, maybe because of what I said earlier. 2020 is a write-off. 2021, it's a recuperation. 2022 is when the world gets back to a more normal world, to the kind of world that we've been used to, but with different characteristics than we had before. And the characteristic being the ones that we mentioned earlier.
So are you saying that the market is looking forward to 2022?
Yeah. And if it goes down, someone will buy it. I will, because I know that I already know that earnings are going to be bad. It doesn't take much of a genius to figure that one out. I know that.
That's pretty obvious. That's the obvious. So
it lives on expectation. Doesn't live on what was yesterday.
Yeah.
So the expectation is that, you know what, we're in a bad time. We're going to recuperate, because we'll find solution to this pandemic. And then in 2022, people are going to start to feel more comfortable. They're going to be more assured of themselves and all the rest of it. And the economy is going to start running at a more normal pace, and the market is going to start reflecting it. Meanwhile, some of the big themes that we talk about are going to start to be implemented, like saving rate is going to go up, corporate tax is going to go down, wealth tax might be introduced. This basic income is going to probably be introduced. Universal health is probably going to be coming into the United States. You're also going to have more movement, of disruption of the supply chain, which will bring lots of software, lots of efficiency type of investments, done by corporation, that sort of stuff. You're going to see all these things, and then but you, as an investor, you have to look at 2022 and say, well, in 2022, when all this stuff is over, what's going to be great? What's going to be the things, that's going to be interesting? What is going to be the big macro themes, and which industry is going to profit from those big macro themes? And which companies are going to profit, from these micro elements that composes, the big macro thing.
I mean, what you're saying certainly explains the behavior of certain stocks and certain sectors are really plowing forward and upward, because the outlook for 22 is so positively charged in their favor. Like if you're talking about, these stocks, the winners of the future because of where we are today, that certainly goes a long way to explaining the behavior of the market. Do you believe, you've already said 2020 is a write-off, and do you believe that the worst case scenario has been factored in by the market?
There's never been, as far as I know, never been a bear market, or a bear market that's lasting when the monetary policy is easy. I'm not aware of any.
Right.
Now, a lot of people will say, the monetary policy doesn't have the same strength as before. Well, it's like saying, maybe I may not have the same strength as I did 50 years ago. I'm only half as strong as I used to be. So all I have to do is put two of me together. Then I'm as strong as I was 50 years ago. So The monetary policy, what they do now is that rather than just doing a tiny bit, they do twice as much or 3 times as much bit than they used to, which has, in the end of the day, had the same effect. The proportions are just changed given the complexity of the economy. You got to be more aggressive maybe in an economy which is a U.S. economy which is running at around $22 trillion than when it's running at $2 trillion. There's a lot more interconnections, a lot more nodes, okay, and a lot more complexities and all the rest of it, and it's $22 trillion economy than a $2 trillion one. So consequently, your monetary policy needs to have much more imagination. You know what I'm getting at.
I think initially there really was nobody knew, what was going to come next before the Fed and the government, the U.S. government stepped in, and in Canada, of course, the similar action from the Bank of Canada and our governments, federal and provincial. I don't think anybody knew that those would be the measures that they would take on this sort of triage-like basis where every day new things are being introduced. It has reintroduced an element of confidence back into the market. It goes a long way to explaining the optimism that we're seeing in the equity market. No, but writing off 2020 as a zero net earnings year, that's already being done.
In the judgment of the market, the year 2020 is like, as I said before, you went into a coma. It's not going to stop. Whatever growth rate, say, that Cisco had, okay, it will resume that growth rate from 2021 base, okay, from the recovery, okay, that's going to happen in 2021. Yeah. And let's assume, I don't know exactly what the growth rate, okay, of earnings, okay, for Cisco was, but let's assume it was 5% per year, to say a number. I don't even know if it's 5%. Don't quote me too much on that. But then it will reflect that 5%. In other words, it's basically saying, no, the market should be at 3,300. That was the high. The market is now, I don't know where it went today. I just don't remember, but whatever it is, let's have a quick look just for the hell of it. The market, okay, the indices, the S&P 500 is 2,800, okay? So, and the low, if I don't remember, was I think it was 2,300 and some, but let's say it was 2,400 to sake of argument. So, if the market's saying, I'm in the middle here, or pretty close, in that range, because I talked about earlier, it's in there, and I'm going to stay in here, okay, towards all of 2020, good chunk of 2021, and when I'm going to start to believe that my square root starts to have the left side of that square root starts to have a little tangent up, I'm going to start to price my Cisco, if you like, or the S&P, okay, and I'm going to go towards, okay, that 3,300 where it was. That 3,300 is going to happen sometime in 2021. I don't know when, June, maybe September, something like that. Whichever, it doesn't really matter what day it is. Yeah.
It's not a question of if, it's strictly a question of when.
I am. Yeah. That's the way I'm positioned. And it would appear that when you think of it, it's not that silly of a scenario.
I think that you've really brought together some very salient thoughts and ideas, and you brought it all together into a really, really nice package. I'm excited now for our future conversations.
This being the first one, I can assure you that next time I'll be more prepared. I didn't even prepare for this. It was really off the cuff.
I think I feel like it's almost probably better that way because I know my imagination tells me that this is something you've done your whole life, and you walk around with these thoughts. They're all right there at the tip of your tongue, and it's almost better to not be prepared because sometimes you do your best thinking out loud too, right?
It comes out more naturally.
So Hubert, I want to thank you so very much. This has been a very productive and a very informative conversation. You're very welcome. I hope to have many, many more like it. It's been very exciting to talk to you today. Thank you so much.